we didn't have an OBR report, OK? And that's basically where we get an independent take from this institution, the Office of Budget Responsibility, of just what the impact is going to be on the economy as well, because, you know, they will be able to give us a sense of how much growth is expected from this. We didn't get that. What we did get from the Treasury, though, are some broad costings. Now, there's something called the scorecard. It's a kind of measure of just how much each of the different policies is expected to cost. And either, if it's something that's going out of the Treasury, it's in negative territory. So those bars would be below the zero line. If it's something that's coming out, if it's basically something that's coming back in, so they're raising money, the lines are in positive territory. And what we can probably tell here, these bars are very negative indeed. There is lots of spending, lots of money leaving the Treasury, mostly in foregone taxes, and just see where it's come. So, for instance, well, let's go over to the kind of the end of the forecast horizon, as they call it. So 2026, 27, the whole thing is coming to about £45 billion. That is a lot of money. It's a lot of money. You know, it's more than you normally get in a typical budget. Going back to that point, it's not a mini budget. Probably the biggest chunk of that, actually, I think more or less the biggest chunk was corporation tax, so reversing the corporation tax rise that was planned by Rishi Sunak. But the reversal of the NIC's rise is about the same cost. You're talking about kind of getting on for 20 billion for each of those. These are enormous sums. They are really enormous sums. And it just underlines that they're planning essentially kind of permanent tax cuts here. The one thing I want to just add on to this, because you're probably kind of asking yourself, where has this come, given it's the most expensive thing of all, is the energy price guarantee and that money for businesses. Actually, you need to add that on to the bottom of where we are now. And that bar there, you can see how it's changed everything, the complexion of everything else, because it makes this bar, the year we're in right now, bigger in terms of spending than any other year. But that's only for 6 months. So you could expect that potentially to be even bigger. Well, it almost certainly will be even bigger. It's just an extraordinary amount of money coming out of the Treasury, going out there into the public, but not being financed by spending cuts or tax rises, being financed by borrowing. And that is really, really striking. Next thing, really, I want to show you is just what the market's doing. Because obviously, if we're doing all of this extra borrowing, and look at it, you can see that's a lot of extra money we need to borrow, hundreds of billions over the course of the future years, then we need to raise it somewhere. Someone needs to lend us that money. That is kind of how it works. And so you need to go out there. Oh, actually, sorry, there's one thing before we get to that. I'm going to show you the market thing in a sec, because this is just taking the big picture and looking at how much in the way of tax cuts we've seen here compared with other previous budgets. So the higher these bars are, the more of a tax-cutting budget you're talking about. So there you can see Ken Clarke, 1996. That was after his period of kind of austerity there. Here you can see Lawson, a few Lawson budgets, Geoffrey Howe, Dennis Healey, Geoffrey Howe, 1982. Lawson, 1988, held up by a lot of people within the Conservative Party as one of the greatest budgets ever, a big tax-cutting budget. Other people would disagree. They'd say that that caused a boom in the early 90s. There's Anthony Barber, 1972, the Barber boom budget. Again, pretty notorious. That did not end well. And here is Kwasi Kwarteng. So that is one of the biggest tax-cutting budgets in history, the biggest we've had in 50 years. And as I was saying a moment ago, has there been some market reaction? Well, have a look. This is just showing you government bond yields, which is the rate at which we are having to borrow this money. So we're borrowing an extra X billion pounds, and the X is a big number, and we are having to pay higher and higher rates on that borrowing. So it means it's more expensive, so it means the debt interest costs are going to be even more in future. That's just what happens when you become a high-debt economy, and we certainly are becoming more of a high-debt economy. You have to pay more for that. And final thing to just note is what's happening in currency markets. Now, this is the pound against the dollar. It's just one of the many exchange rates against sterling. And this is literally just the story of the day. So the charts I was showing you a second ago is looking back many years. This is just looking back today. So that's last night. Here's the morning. And you can see for most of the morning, the pound was kind of round about the level of about $1.12 against the dollar. Well, when Kwasi Kwarteng stood up, it was about $1.12. By the time the markets had begun to react, it was down to about 111. And last time I looked, I need to update those charts, but last time I looked, it was down below 111, so getting for 110 and a bit. That's quite worrying. I think that's the kind of thing the Treasury will be worried about, but we have to wait and see.